Friends, if you do trading and want to understand charts properly, then candlestick patterns are very important for you. These patterns show the psychology of buyers and sellers in the market, which helps us understand the direction of the market. Candlestick patterns work in every market, whether you trade in crypto, forex, gold, or commodities. Now, there are many candlestick patterns, but not all of them are useful in practical trading. Only a few patterns are really important. So in today's video, we'll understand 10 high-probability candlestick patterns in very simple language. We'll talk about the meaning of each pattern, the market psychology behind it, and how to use it with some easy examples. So make sure to watch the video till the end, because at the end, I'll share one very important tip that most beginners usually ignore. So friends, the first pattern is the hammer. Hammer is a bullish reversal pattern that generally forms after a downtrend, and after its formation, we often get to see bullish momentum in the price. One important condition of a hammer candle is that its lower wick should be at least 2 times bigger than the body, and this candle can be either green or red. The hammer candle shows that sellers tried to push the price lower, but buyers made a strong comeback and pushed the price back up. And if a hammer forms near a strong support level, then its success rate increases a lot. Now, regarding entry on the hammer pattern, some people say that you should wait for a confirmation green candle after the hammer, which should close above the hammer's high. But because of that, the risk to reward ratio often gets disturbed. That's why I personally prefer entering the trade as soon as the hammer's high breaks. This gives me a better risk to reward ratio, and the stop loss should be placed below the low of the hammer. Now let's talk about the shooting star pattern. Basically, the shooting star is the opposite of the hammer, and it is a bearish reversal pattern. This means it usually forms after an uptrend, and after its formation, we often see a fall in price. In a shooting star candle, the upper wick is long while the body remains small, just like the hammer, and this candle can also be either red or green. Here, the psychology is like that of a hammer, but opposite. And the entry rule here is also the same. When the low of the shooting star candle breaks, you can enter the trade, and the stop loss should be placed above its high. Now let's move to another important pattern, the Doji pattern. Mainly, there are 4 types of Doji patterns: standard Doji, long-legged Doji, dragonfly Doji, and gravestone Doji. In these candles, the opening and closing prices are almost the same, and these candles can either be colorless or have any color. Now, if you notice carefully, the dragonfly Doji works exactly like a hammer pattern, and the gravestone Doji works like a shooting star. Now let's understand the remaining standard Doji and the long-legged Doji. Both of these candles show indecision in the market. It means neither buyers nor sellers are able to take control of the market. The market remains confused. Generally, the Doji pattern gives a signal that the trend may be getting weak. For example, if a Doji forms after a strong uptrend, it means that buyers are becoming weak. And if it forms after a strong downtrend, it means that sellers are becoming weak. But remember, a Doji alone does not confirm a reversal. It only gives a warning that something in the market may change. So if you want to take a reversal trade based on a Doji pattern, then confirmation from the next candle becomes very important. And one more important thing, the Doji pattern becomes much stronger when it forms near an important support or resistance level. Now let's talk about a very powerful pattern, that is bullish engulfing. This is traders' favorite reversal pattern, and it is formed by combining 2 candles, where the first candle is bearish and the second candle is bullish. And this bullish candle completely covers this bearish candle, which shows that earlier, sellers were controlling the market, but suddenly buyers entered the market so aggressively that they completely absorbed the sellers. If bullish engulfing forms near a support after a downtrend, then we get a buying opportunity here. This pattern is a very powerful bullish reversal pattern that you will often see on the chart. The exact opposite of this is bearish engulfing. In this, the first candle is bullish and the second candle is bearish. Here, the bearish candle completely covers the bullish candle, which shows that the control of buyers has now been taken over by the sellers. This pattern generally forms after an uptrend, and if it forms near an important resistance, it can reverse the price and bring it down. Therefore, we get a selling opportunity here. The next candlestick pattern is bullish harami. In this, harami is a Japanese word which means pregnant lady, and the structure of this pattern is quite similar to a pregnant lady, just like bullish engulfing. This pattern is also formed by combining two candles, where the first big bearish candle is called the mother candle, and the second small bullish candle is called the baby candle. This baby candle forms inside the mother candle, and this pattern shows that the selling momentum is now slowing down. If this pattern forms near the support in the chart after a downtrend, then from here the price can go up and we get a buying opportunity here. The exact opposite of this is bearish harami. The only difference is that in this, the mother candle is bullish and the baby candle is bearish. This pattern generally forms at the top of the chart after an uptrend, and it can bring the price down, which creates a selling opportunity here. Next candlestick pattern is bullish marubozu. This is a strong buying candle whose body is comparatively long. Generally, there is no wick in this candle, or it is very small. This candle indicates that buyers controlled the price throughout the entire session. Now understand, if a bullish marubozu forms after a downtrend, it signals a price reversal, means the market can go up from here. And if a bullish marubozu forms somewhere in the middle of an uptrend, it signals a trend continuation. This gives buyers confidence that the buying pressure is still maintained in the market. Now, because this candle is a bit large, the stop loss here is also a bit big. Now let's talk about bearish marubozu. It shows the exact opposite psychology of a bullish marubozu. This is a strong selling candle, and here sellers are controlling the price. Similarly, here too, if a bearish marubozu forms near resistance after an uptrend, it signals a reversal, and if it forms in the middle of a downtrend, it signals a trend continuation. Now we come to our last candlestick pattern, that is inside bar pattern. At first glance, this pattern might look like a harami pattern to us, but it is quite different from the harami pattern. We use this for trend continuation. Its identification is something like this. During an uptrend, a big green candle is formed, and a small red candle is formed between the 50% level and the high of this big green candle. Similarly, during a downtrend, a big red candle is formed, and a small green candle is formed between the 50% level and the low of this big red candle. Whenever this inside bar candle forms in the market, a strong momentum is seen in the price, just like you can see here on the chart. Similarly, this pattern works very well during a downtrend too. This pattern is my favorite pattern because the stop loss here is very small, while the targets are big. Now at last, an important tip that every beginner must know. Trading just by looking at candlestick patterns is not right. You should combine every single pattern with support and resistance, trend, volume, and market structure, and then use it. Only then will you be able to find high probability setups. So friends, these were the 10 most important candlestick patterns that we understood in detail in today's video. Only these many patterns are important in the market. Other patterns either form very rarely or their risk-reward ratio is not good. If you found the video helpful, then definitely like the video, subscribe to the channel, and tell us by commenting which topic you want the next video on. See you in the next video. Thanks for watching.